Welcome back to the deliberations of the Citizens Monetary Policy Committee of CNBC-TV18. I have been speaking to our MPC members, Samiran Chakrabarti, Shaumya Kanti Ghosh, Sonal Verma, Sajid Chinoy, and Dr. Pranab Sen. Gentlemen and Sonal, thank you very much for waiting on. Well, Dr. Sen, I'm going to repeat this intersection of the global question and the domestic question. Will not, maintaining the interest rate differential with the US be a predominant question that will worry the MPC? Can they ignore what's happening on the external front and to the rupee and other Asian currencies?
No, Lata, of course it can't be ignored. But the point is there is nothing sacrosanct about the differential between the US and the Indian rates. Yes, our rates will have to be higher, but I don't think we have to maintain a fixed band, which means that our entire monetary policy becomes captive to what the Fed is up to. I don't think that's either necessary or, in fact, more importantly, even desirable. So I would actually de-link this. I mean, the Fed is doing certain things because it has particular compulsions, and we cannot blindly follow that. We have to keep it in mind, certainly, but we have to take our decisions depending upon how the macro dynamics within the country are playing out.
Okay. Yes, I agree. I was just worrying that our inflation looks like in the future is going to be more persistent than perhaps the Fed's, perhaps the US, going by what the dot chart is telling us. But time permitting, I'll come to that again. Shaumya, we never discussed the liquidity backdrop. After all, the stance is withdrawal of liquidity, and last couple of weeks we have had banks going and borrowing from RBI for want of money. So do you think we need to, the RBI may be even forced to provide liquidity at some point in time, considering that they will be selling dollars? It doesn't look like that's going to stop.
No, I think, Lata, that's a very important question, but we need to understand the proper perspective. If you look into the RBI last guidance, I think giving a forward guidance uncertain times is absolutely not possible because, but the withdrawal and accommodation, I think it should need to stand like that one because technically the RBI liquidity the net LAF is a function of 4 factors. The standing liquidity facility, which is put to the primary dealers, that is not added onto that. If you don't add that, the RBI liquidity actually was in a minor surplus and not in deficit some time back. So that's first point. The second point is that if, for example, suppose I change it to neutral. Neutral means the inflation management is now the top priority. Neutral means it could go either side. So the market actually can get confused by that signal, and the withdrawal of accommodation should continue to be the motto, because remember, 4 trillion is government cash balances that is still lying over there. So the core liquidity actually is a surplus of 4.1 trillion. And the other important thing is that yes, selling dollars will suck out liquidity. That's a very interesting point. But there is also another factor is that the currency in circulation has not changed significantly in the last 2 years thanks to a rapid surge in the digital transactions. So if I take all these factors into account, inflation management continuing to be the top priority, I think the RBI should continue to focus on withdrawal of accommodation, given that the cash balances of the government and the core liquidity still remains in a positive mode, and it doesn't look like going away immediately in a hurry. So in my sense, let it remain like that one and let it continue to do whatever it is doing in the market.
Okay. Okay, withdrawal of liquidity accommodation would be your choice of stance. I'll anyway put it to vote. Sajid, I wanted to get this thought from you as well. The need for this 2%, the need for interest rate differential. Do you think that will play? And I'll ask you why. I want to know what is your peak rate expectation from the Reserve Bank. If the Fed is saying its peak rate is a good 50 to 75 basis points more than what we thought just 2 weeks ago or 1 week ago, will not the Reserve Bank's peak rate also have to go to 6.5 or 6.75?
So, Lata, I agree with Dr. Sen that we don't have to move one for one with the Fed for a very simple reason. Think of the impossible triangle or the trilemma that economists refer to, right? That you can't have simultaneously a fixed exchange rate, an open capital account, and independent monetary policy. So if we want to have independent monetary policy and our capital account is relatively open, the exchange rate has to become the shock absorber. And if that becomes the shock absorber, that allows you to then run independent monetary policy. And therefore, I'm very happy to see that after the last Fed meeting, we've seen the exchange rate depreciate and let off some steam and become the shock absorber. So because of the dynamic, you don't have to move one for one. But as Sonal pointed out, a weaker exchange rate will add to domestic inflation pressures. Those pass-through estimates today are higher than what we believed a year ago. In a recent article, Deputy Governor pointed out for every 5% depreciation, you should expect to see about 40 basis points in higher CPI. So I think the way monetary policy needs to respond is the exchange rate becomes a shock absorber, particularly to respond to global shocks and ensure the current account deficit narrows. That weaker currency, along with the domestic food pressures that Shaumiran pointed to, mean there are upside risks to inflation. And as a consequence, monetary policy under the flexible inflation targeting framework should be reacting to the inflation implications of a weaker exchange rate. And that means, Lata, two things. I'll end by this. We don't need to move one for one, but we will need to move more than we thought 2 months ago. And so for what it's worth, our terminal rate is also 50 basis points higher. We think the RBI will need to end closer to 6.25%, and therefore not move as much as the Fed, which still has to move another 150 basis points this year.
Okay. Oh, right. But there are others who are already at 6.25%. Sonal, what would be your peak rate? How much has it moved in the last 2 weeks for you?
So, Lata, our terminal rate is around 6.25% already. And this was on the back of our US team lifting their terminal rates to 4.75%. In fact, last Friday, they now think the short-term neutral rate in US is even higher. So they've lifted their terminal rate to 5.5%. So that does put some upside risk to our terminal rate forecast. But I think near-term response needs to be there. But I think monetary policy has to be forward-looking and has to take cognizant of the fact that policy works with long lags. So I don't think we should be overreacting to just global developments. Local development should play a priority.
Okay, no, I agree, but I'm only taking all that you're saying that the global events are going to have a local impact. Very quickly, a last question. Would you raise your terminal peak rate after the global events of the week?
So I would rather watch on a couple of things how the MPC is reacting. One is that in our view, 6% is around the neutral rate. So anything above that is restrictive. Is the MPC open to making the policy restrictive in some sense in the Indian context? And the second thing is that would they be concerned about the fact that till Fed keeps on hiking, MPC will have to at least do a creeping rate hike just to keep it going. Yeah. If these two things are there, then possibly the terminal rates are significantly higher. So the upside to our 6% number seems to be playing out quite nicely now.
Okay. Well, I shouldn't dare, but my personal view is that this import is a big worry, and that will mean something will have to be hiked to slow down the economy, because imports will be substantially higher this year. Anyway, it's time to vote, and may I ask you the first and most important question? How much will the rate action be from the MPC in this policy? Samira.
We are calling for a 50 basis point repo hike.
Shaumya?
We are calling for a 50 basis point
50 basis hike. Sonal?
50 basis point hike.
Okay. I'll come to Dr. Sen later. Sajid?
A 50 basis point hike.
Chairman, sir, 4 of your members, 50.
Well, I agree with Shaumiran's diagnosis. I would say the rate should creep upwards. I would go to 35.
Okay. All right, Chairman, sir, but outvoted by your members. The stance, I know it's a little difficult to put it in few words, but again, Shaumiran, withdrawal of accommodation, does it change? What's the new stance?
We believe that we are very close to the June 2019 point where we moved from neutral to accommodative. So now we should be moving to neutral back again. That will remove all the accommodation during COVID. I think that's where the stance should be now.
So neutral.
Neutral.
Saumya?
I think it should remain the same.
Yeah, you argued that accommodation is still there. Okay, Sonal?
I think it should move to something around neutral, but at the same time, I think, whether it's a liquidity stance, rate stance, at this stage, the stance really has very little value to add.
Okay. All right. Sajid, what would the stance be?
Well, the RBI's own sense of neutral in real rates is over zero. We're not there yet.
Okay.
So we're not at neutral. Therefore, I think you should remain with a withdrawal of accommodation.
So unchanged stance. Dr. Sen?
Well, the RBI has actually fought shy of giving a very clear stance in the last few MPC meetings. And I suspect they'll just continue that. I don't think they want to take a definite position.
Okay. All right. So I will take that as no clear stance then, though you're saying it will be a continuation. So there are only actually two people expecting a change in stance. I would count Dr. Sen more as unchanged stance. But the important point is a 50 bips hike is the majority vote, 4:1 from the Citizens MPC. Thank you very much for joining us in the special deliberations of the Citizens MPC.